You undoubtedly want to be a millionaire like Warren Buffett if you're viewing this video. Nevertheless, you actually have a significant advantage over Buffett in terms of producing returns if you have a relatively little amount of money in your portfolio. You have the benefit of not being a billionaire. Okay, we'll admit that statement doesn't sound very convincing at first, but in this video, we're going to explain why having less money in your portfolio than Buffett can actually help you outperform the renowned Oracle of Omaha. Buffett's net wealth is over $100 billion at the moment, but it wasn't always like that. Buffett spent his formative years in Omaha, Nebraska in the 1930s and 1940s, distant from a thriving global financial hub. His family was middle class at the time, and he didn't begin his investment career with a trust fund. This indicates that at one point, his financial portfolio only contained a few relatively small quantities of money. In actuality, Buffett's best returns throughout the course of his career came when he was in his 20s and 30s, and only managing money from affluent Omahans, a far cry from the $650 billion businesses he now oversees. It's crucial for those of us who don't yet have billions of dollars in our investment portfolios to learn how Buffett made his decisions at this point. Hey, welcome to Stock Market Mate. Today we'll talk about how Warren Buffett wants you to invest a small amount of funds. But before we hear from Buffett, subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it.
My question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold,
do these stocks have names?
well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, you know, I've got this wonderful thing, and I usually know ahead of time, but I mean, I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money, that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and you know, it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then. Charlie?
Well, I can remember when you bought one membership in some duck club that had oil under it when you were young.
Yeah, there was a company called Atlas.
When you get down to one duck club membership, well, you're really scavenging for cigar butts. But
not a bad cigar butt. There were 98 shares outstanding. It was the Delta Duck Club, and the Delta Duck Club was founded by 100 guys who put in $50 each, except two fellows didn't pay. So there were only 98 shares outstanding. They bought a piece of land down in Louisiana, and one time somebody shot downward instead of upward, and oil and gas started spewing forth out of the ground. So they renamed it Atlas, which is Delta spelled backwards, which was sort of illustrated the sophistication of this group. And a few years later, they were taking, at $3 a barrel oil, they were taking about $1 million a year in royalties out of the place, and the stock was selling at $29,000 a share, and it was earning $10,000 a share. No, it was earning about $7,000 a share after tax, about $11,000 pre-tax, and it had about $20,000 a share in cash, and it was a long-lived field. So, you know, I use that sometimes as an example of efficient markets, because somebody called me and offered me a share of it, and those things, is that an efficient market or not? 29,000 for 20,000 of cash plus 11,000 of royalty income at 25-cent gas and $3 oil. I don't think so. You can find things out there. I'll give you hunting rights on all my duck clubs in the future.
The fact that you don't need to make big investments is the first benefit. Let us clarify our meaning. The market capitalization of Warren Buffett's business, Berkshire Hathaway, is currently $660 billion. What size investment do you believe Buffett would need to make in order to, as he puts it, move the needle? Let's just say, using round numbers, that an investment must account for 10% of the total worth of the company in order to have a significant impact on the company's performance. Therefore, for that investment to reach the 10 criterion, it would need to be worth approximately $65 billion or $70 billion. Let's take a look at some businesses that are currently valued in that region in order to put that into perspective. General Electric, one of the most recognizable businesses in the world, is currently valued at about $80 billion. At this time, Airbnb is worth $70 billion. FedEx, a package delivery service, is currently valued at $61 billion. Ford's market worth is $58 billion. Marriott, a hotel chain, is currently valued at $52 billion. Therefore, each of these businesses is enormous. To have a genuine impact on Berkshire Hathaway, though, Buffett would need to make an elephant-sized acquisition and purchase one of these enormous corporations. As a result, the number of prospective companies is constrained. Any significant investment can be made by Berkshire. As Berkshire continues to grow, Buffett's pool of potential investments gets fewer and smaller. In contrast, consider a lone investor who has a modest investment portfolio. Let's apply the same 10% criterion and state that an investment must account for 10% of the investor's net wealth. This investor's investable universe is practically unlimited. Thus, it must be categorized as significant. Because there are more prospective investments available, this investor can invest in anything, from the biggest businesses in the world to little businesses in this area. An individual investor has a considerably higher chance of finding an undervalued investment. This dynamic is perfectly shown by the investment in the Delta Duck Club that Buffett mentioned. When it was discovered that the property the club's owners held actually had lucrative oil underground, the Delta Duck Club, which had originally been founded as a hunting club, swiftly changed from a hobby to a business. Only 98 shares of this firm were ever issued. Each share was valued at $9,000 and earned an annual after-tax income of $11,000. Each share represented $20,000 in cash at the time of trading. You were essentially paying $9,000 for an investment that gave you an after-tax profit of $11,000, after deducting the $20,000 in cash from the $29,000 acquisition price of the share. This is what would be referred to as a complete no-brainer in the world of investment. Regarding whether or not this is a wise investment, there is a significant caveat. The size of the portfolio making this investment will determine the answer. Only 0.0004 of the company's market cap would be invested if Berkshire made this purchase today. Since this investment represents such a little part of Berkshire's value, it would be practically pointless. It wouldn't even be worth Buffett's effort to make it. Simply put, it wouldn't make a difference. On the other hand, imagine that we have a single investor with a $30,000 total investment portfolio. For him, this investment in Delta Duck Club would be fantastic because it would account for a big chunk or almost all of his net worth. With a relatively small investment, it would effectively move the metaphorical needle for our investor. This brings us to the second reason why spending small amounts of money is advantageous: less competition. In the world of stocks, the size of the corporation typically grows. More investors are paying close attention to the company. The less likely it is that a stock is inexpensive, the more attentively investors follow it. Yes, there are exceptions to every rule, but in general, this one holds true. Let's use an Apple as an example. Many thousands, if not tens of thousands, of wise investors closely monitor Apple's stock. Additionally, these investors attended prestigious universities and work at some of the most well-known hedge funds and investment banks in the world. Apple is currently valued at $2.6 trillion due to its size. It attracts a lot of attention, and a lot of intelligent people keep up with the business's every move. Due to how closely people follow the company, there is a low chance that Apple will become drastically undervalued. Contrast that to a stock that is only worth, let's say, $100,000. Just owing to its lower size, this stock will naturally garner less attention from investors. The stock certainly has a minuscule fraction of the people following it compared to a major corporation like Apple. This dynamic makes it more likely for the market to undervalue smaller businesses. To locate inexpensive stocks, there are more opportunities in smaller companies, which is why Buffett stated that if he were managing tiny sums of money, he would concentrate on investing in them. The less competition, the better. So we know that most films here on YouTube that talk about Warren Buffett's financial ideas aren't the most practical. This means that there aren't many concrete bits of advice that you can start implementing right now in your personal investment strategy. Our goal for this video is to be able to truly provide you with tangible takeaways you can begin to assist develop your portfolio. So for our examination of Buffett, here are 3 pieces of useful guidance on how to invest modest sums of money. Buffett's first piece of advice is to look in places where others don't. You have the advantage of being able to invest in items that are simply too tiny for major institutional investors when you invest small amounts of money. Don't lose that advantage by continuously attempting to compete with these powerful players. Instead, concentrate on investment opportunities that are just too modest to be significant for investment funds with hundreds of millions of dollars. Our concrete illustration of this may be hunting for stocks in particular nations that aren't well liked by institutions. Professional investors frequently concentrate on stocks with American roots. However, there are many excellent businesses throughout the world that can be undervalued in comparison to those in the United States. The second piece of advice is to concentrate on smaller businesses. Warren Buffett has previously stated that he would spend his time concentrating on smaller companies since there are more opportunities for bargains in this sector of the market if he were managing a much smaller sum of money. Peter Lynch and other reputable investors agree with this sentiment. Lynch popularized the phrase 10 baggers, which refers to investing in a stock that increases by a factor of 10 from the moment the investment was made. The dream of every investor is a 10 bagger. It makes sense that he has stated that a small business can grow 10 times more easily than a large business. According to common sense, increasing a company's sales from $1 billion to $10 billion is significantly simpler than increasing sales from $100 billion to $1 trillion. It becomes more difficult for a corporation to continue growing at the same rate as it grows larger. Looking in what is known to as an inefficient market is the next piece of advice. In an inefficient market, the price of an asset does not fairly reflect the worth of that asset. Well, that's about it for today's video. Let us know your thoughts in the comments section. If you found this video helpful, kindly click the like and subscribe button. Thank you for watching, and we'll see you in the next one. If you enjoyed this video, you're going to want to watch one of these 2 videos right here. Enjoy!